Hello guys, and welcome back to another video. Today I'm gonna go over a couple of trades using the Volatility Impulse indicator, and I'm using the indicator with standard settings. I'm on the 1 minute chart, Euro USD. So the first trade is about this retest of the support level. As we can see, the price drops into the level, and at the same time we can see that the Volatility Impulse indicator crosses below the lower line, and this is a sign of a potential reversal. And we have two confirmations in place. The price is at the support level and the volatility indicator crosses below the lower line. So we have a high likelihood of a reversal. So we can enter long on the next green candle that closes above the support level. And the target for this trade is a new high. We can take partial profit, and then we can secure the rest when the volatility indicator crosses above the upper line. So this is a great example of how the Volatility Impulse indicator can confirm this trade on the support level. The next trade is about this pullback trade at the supply zone, and as we can see, the market drops all the way back down to this previous support area, and we make a new low. This can be a good long setup. However, we can see in the volatility indicator that the price line does not cross under the lower line. So this is not a valid long setup. So I'm just waiting to see what happens. And as we can see, the price comes all the way back up to the supply area. And once the price hits the supply zone, we can see that the volatility impulse indicator crosses above the upper line, and this is a clear sign that this supply zone will be respected and the price have a high likelihood to reverse back down. So we can enter short in this area and put our stop loss slightly above the supply zone, and our target for this trade is around this area, since we see that the price have reacted in this area before. So this is a good target zone. So we can exit our short position right there. And this is another great example of how the volatility indicator can confirm this short trade at the supply area. The next trade is this Fakeout Trade. We can see that the price breaks the previous lows and this support area and immediately bounce all the way back up and make a new higher high. So how can we identify this potential fakeout move using the Volatility Impulse indicator? First of all, it's important to recognize that the price actually breaks below the previous lows and this support area. That is the first thing we have to recognize. The second thing is to recognize that this candle creates a huge wick, indicating that there is buying power under those lows. And at the same time, we can see in the volatility indicator that the price line crosses below the lower line. So we have two confirmations in place. This candle makes a huge wick. The volatility impulse indicator crosses below the lower line, and the price have broken the previous lows. And once we see this huge wick and once we see this huge wick, we can enter long on the next green candle that closes above this previous support level. And since it's a fake out move, we expect a quite great movement up, since this fake out move often fuels a great move to the upside. So our target can be this supply area. We can take partial profit, and then we can trail the rest and see how far we can go. And at least we can expect a new higher high to be made. So this is how we can identify potential fake out moves using the Volatility Impulse indicator. In this example, we have 2 short trading setups and 1 long trading setup, and the concept is similar as before. You want to look for short trades in the supply zone and for long trades in the demand zone. So once the price hits this supply zone, we are preparing ourselves for a potential short setup. And as we can see, we can use the Volatility Impulse indicator to confirm that the short trading setup is valid in this area, since the price line crosses above the upper line. So we can enter short when the price hits the zone at the same time as the volatility indicator crosses above the upper line. We can put our stop loss slightly above the supply zone, and then we can take profit once the volatility impulse indicator crosses below the lower line. So this is a great scalping short trade. And as we can see, price comes back up again to the supply area, and we are getting ready for a potential short again. And as we can see, the volatility impulse indicator comes really close or peaks up to the upper line, which can be a good sign of a potential short. And in this case, the price hits the zone and then a big red candle is formed. This can be our confirmation to enter short. And our target for this kind of trade, since we make a lower high, we can expect the price to come back down to this demand zone. So our target is the demand zone. So this is another great short example using the volatility indicator. And at the demand zone, we are looking for long entries. So in this case, the price does not peak under the lower line, so we do not enter long at this test of the demand zone. Instead, we wait and see what happens if the price comes back down again into the zone. And in this case, it comes back down, breaks below the zone a bit, at the same time as the volatility impulse indicator crosses below the lower line. And this can be a great long setup. So we can enter long on the next green candle that closes above or inside this demand zone. And we can take our profit when the volatility indicator crosses above the upper line. So this is how simple and effective the volatility indicator can help us confirm trades around supply and demand areas. Thanks for watching and see you next time. Bye.